Good afternoon.
Good afternoon, sir.
Good afternoon, sir.
Hi. So let's start now. You can remember this diagram. So this is the entire business analysis process. So you start with understanding about the business, company strategies, business environment. Then in the financial statement analysis, you see before the financial analysis, you have to do the accounting analysis. You can remember last few weeks, we were discussing about analysis tools and techniques. So we have studied how to do a financial analysis. But practically, before applying any analysis tool to your company's financial statements, you have to do accounting analysis. You see, accounting analysis. So before doing trend analysis, common size analysis, ratio analysis, before doing any analysis, so you have to do accounting analysis. So today we are going to study this. Right. So we have now idea about analysis tools and techniques. But practically, before applying any analysis tool, you should do accounting analysis. Now here what happens is you try to get ready your company's financial statements for the analysis. So you try to ready your financial statement to start the analysis. So that's what we are going to do. Practically, so you may work as internal financial consultant. So when you are an internal financial consultant, so you don't get every time audited financial statement. As an internal consultant, you support the company's management's decision-making process. As an internal consultant, what you do is you provide company's management analysis information to support their decision making. So you don't get every time audited financial statements. So you may work with financial statements prepared for management purposes. So we call internal financial statements. You may work with draft financial statements. So as an internal consultant, you don't get every time audited financial statements to do the analysis. Sometimes you are analyzing the monthly accounts, monthly financial statements. Sometimes you analyze quarterly financial statements. There are situations you have annual financial statements, but they are not audited, unaudited. You have unaudited annual financial statements. So we call draft financial statements. Draft financial statements. So particularly as an internal consultant, you may work with unaudited financial statements. You know, in unaudited financial statements, there may be misstatements, there may be significant errors, frauds. Sometimes these unaudited financial statements have not been prepared according to the accounting standards. Company may not have applied some accounting policies. When company prepares unaudited financial statements. So before that audit, company prepares the financial statements. There are situations company may not have applied all the accounting policies. So as an internal consultant, you see, you work with in many times such unaudited financial statements. Therefore, these financial statements may not be suitable to start the analysis. These financial statements may not be suitable to do the analysis. So in the accounting analysis, what you do is you make the financial statements suitable for the analysis. You make the financial statements suitable for the analysis. So once you have done the accounting analysis, then your financial statements are ready to start the analysis. So you can start the financial analysis. Now you see, before doing any analysis, you have to make sure that the financial statements are suitable for your analysis. Right. So that's what the objective of accounting analysis. Simply, in accounting analysis, you try to make the financial statements suitable for the analysis. Suitable for the analysis. Now the example. So you may be external consultant. There are occasions you are an external consultant. So you are not internal to the company. Sometimes you consult various investors in making their investment decisions. So in such situations, you have audited financial statements. because you don't have the access to the company's internal management account. As an external consultant, for example, you consult stock market investors. Then you have only the access to the audited financial statements. You can find audited financial statements from the company's annual report. But here also, accounting analysis is important. Now let's say one of your client, an investor, has asked you an advice. Now let's say two companies are going for a share issue. Let's say seasonal public offering. So those terms you have learned in financial management. Then let's say XPLC and YPLC. So these two companies are going for a seasonal public offering. So one of your investor, one of your clients has asked an advice. Now that client wants to know which company is better investment. Now you see two companies are going for a share issue. So your client needs to know which company is a better investment, whether X or Y. Then as an external consultant, so you analyze two companies, then you can advise your client which one is better investment. Now before the analysis, now you are going to compare two companies. Before the analysis, you have to see whether financial statements are comparable. Whether financial statements of XPLC is comparable to YPLC. Now you analyze two companies, then by comparing the result, you are going to suggest your client which one is better investment. So you are going to compare the financial results of two companies. But before doing the analysis, you have to make sure these two companies' financial statements are comparable. For example, let's say YPLC depreciate assets on reducing balance method. XPLC depreciate on reducing balance method. YPLC depreciate on straight line method. Now you see the company's depreciation policies are different. Now are these financial statements are comparable? You see companies' depreciation policies are different. Therefore, they are not comparable. So this is one example. Now you see you can't start the analysis because the two financial statements are not comparable. Another example, let's say XPLC calculate cost of inventory on FIFO basis. YPLC calculate cost of inventory on weighted average cost basis. Now you see inventory cost measurement policy is different. XPLC on FIFO basis, YPLC is using weighted average cost basis. You see, two companies, inventory cost policy is different. Inventory cost measurement policy is different. Now, can you compare two companies? Can you compare two companies? So you can't compare two companies because their accounting policies are different. Their accounting policies are different. Now, example, let's say XPLC has prepared financial statements in US dollars. YPLC has prepared financial statements in Sri Lankan rupees. Now, can you compare two companies? Can you compare two companies? Because you see, exchange rate between dollars and rupees has impact on these two companies' financial values. So you can't compare two companies because their reporting currencies are different. Their reporting currencies are different. Another example, XPLC has prepared annual financial statements, but YPLC just started company. It is a company started during the year, then financial statements only for 9 months. Now you see XPLC has prepared annual financial statements, but YPLC is a company started during this year. Therefore, that company has prepared financial statements for the 9 months period because the company has started during the year. Now, can you compare two companies' financial statements? You can't compare because the two companies' reporting periods are different. Two companies' reporting periods are different. Now you see, you can't just start the analysis. So once you have the financial statement, you can't just start the analysis. Before the analysis, before doing any analysis, you have to make sure that the financial statements are suitable for the analysis. So before starting your analysis, you have to make sure the financial statements are suitable for your analysis. So that's what the objective of accounting analysis is. That's why if you see the diagram, you see before starting the financial analysis, you have accounting analysis. Before starting the financial analysis, you see accounting analysis. You see accounting analysis is first, then you can move on to the financial analysis. But on the top of that, you should know about the business environment. You should know about the company. You should know about the company's strategies, the industry within which the company operates. So that's the first step in the analysis process. Because without knowing that, you can't do anything. That's why I have asked you in your assignment to study about the company, industry, the business environment. That's why I gave you 3 weeks. 3 weeks. Right. So if you have done it by now, then you can do a good design. Otherwise, you don't get a good output, good analysis report. Right. Now you see that knowledge is important. You see the arrow here? That knowledge about the business environment is important even to accounting analysts. Now you see the process again? You first have knowledge about the business environment, company strategies, industry, then accounting analysis. After that, you can do financial analysis. So in the accounting analysis, you try to make the financial statement suitable for the analysis. You try to make the financial statement suitable for the analysis. So once the financial statements are ready for the analysis, then you can do the financial analysis. After that, if you need, you can do the forecasting. Right. So we are going to study how to do forecasting. Right. So now you see the process. So today onwards, that may go for 3 weeks, 2 or 3 weeks time. We are going to study this accounting analysis. So every time you keep in your mind, the accounting analysis, we try to make the financial statements suitable for the analysis. For example, we see with the accounting policies are consistently applied. So we check accounting policies. Now let's say you are analyzing over 5 years, last 5 years. You check last 5 years, all the accounting policies and see whether those policies are consistent throughout the period. So that's just one thing you do in the accounting analysis. Right. Now the example, you see whether balances in the financial position are fairly represented at appropriate values. Then you can make sure the financial position values are suitable to do the analysis. Now the example, if you are comparing two companies, then you make sure that two companies' accounting policies are not significantly different. There could be minor differences. But if they are significantly different, you can't compare two companies. So these are some examples of things or activities you carry out in the accounting analysis. Right. Then for the ease of your understanding, we have divided accounting analysis into 3 categories. So you can see this in your first handout in lesson number 1. Now for the ease of your understanding, so we divided the accounting analysis task into 3 categories. You see 3 categories: analyzing financing activities, investing activities, and operating activities. Now we have 3 lessons under accounting analysis: analysis of financing activities, analysis of investing activities, and analysis of operating activities. So these, if you see financial statements logically, these 3 activities you can see from financial statements. So from your financial statement, these are the 3 activities you can find out: investing, financing, and operating activities. Investing, financing, and operating activities. Now let's see a simple example. So let's see how these 3 activities are presented in the financial statements. You know, company invests in resources, assets. So company has to invest in long-term assets, we call non-current assets, and working capital. So you know about working capital because you have studied in financial management. So when investing in working capital, you find current assets and current liabilities. For example, let's say you buy stocks, then you have current assets, stocks. Let's say you don't have money to pay for stocks, then you buy on credit. If you don't have money to pay for stocks, you buy on credit basis. So when you buy stocks on credit basis, you have trade creditors. You have trade creditors. So trade creditors are current liabilities. So if the suppliers won't give you credit, then you have to go for short-term financing, like bank overdraft. Bank overdraft is current liability. Bank overdraft is current liability. Now let's say your stocks are sold on credit. Let's say your stocks are sold on credit. Then you have trade debtors. Trade debtors. So trade debtors, current assets. So when you sell stocks on credit, you know your cash receipts are delayed. You don't receive cash at the time of sale. You get cash lately. then you have to delay expenses. Now, when cash receipts are delayed, you may not have enough cash to pay expenses now. Then you have to delay the payments. You have to delay the payments for expenses. Then what happens is accrued expenses. Accrued expenses. Then once you receive cash from debtors, so you can pay accrued expenses, then what's remain goes to the cash balance. Now you see, so while the operations are going on, you have to invest in working capital. You have to invest in companies' working capital. So working capital consists current assets, current liabilities, current assets, and current liability. Now you see, to start the company's operation, the company has to invest in working capital. Company has to invest in working capital. In addition to non-current assets, company has to invest in working capital. You know, these current assets are gross working capital. Gross working capital. Current assets are gross working capital. So this working capital is financed mainly through current liabilities. This working capital is financed through current liabilities. Now you see, current liabilities are for financing working capital. This is for financing working capital. Now you see, company carries out investing activities, investment in non-current assets like property, plant, and equipment, investment in subsidiaries. Those are investing activities. Those are investing activities. Then your non-current assets investment has to be financed. So you may go for bank loans, leases. For example, from bank loans, you buy property, plant, and equipment, machinery, land, building, motor vehicle. Through leases, you buy property, plant, and equipment. Like more popular examples, motor vehicle, machineries. In addition, company can issue debentures for the investment in property, plant, and equipment, and various other investments. Investment in subsidiaries, for example. Right. So we call this kind of sources debt financing. Debt financing. In addition, company use equity financing. Equity financing. For example, issue of shares, equity shares, reserves. You can use your retained earnings. Retained earnings. You can use your past retained earnings to finance future investment. So we call them equity financing. Equity financing. Right. So these are also for investment in double plant and equipment and various other long-term investments. Now you see company carries out, now you see in this example, you see company carries out investing activities. Then company has to finance the investment. You see working capital is financed, for example. Working capital is financed through current liability. There are situations you are using long-term sources to finance working capital. You have learned those in financial management. There are situations you are using long-term financing sources to finance your working capital. And you see company carries out various investing activities. Then those investments company has to finance. Now you see two types of activities. Investing activities. Investing activities. Investment in non-current assets. And investment in working capital. Then financing activities. Financing working capital and financing your long-term assets, non-current assets. Now you see company carries out investing activities. Then those investing activities are reflected under non-current assets and current assets. Company carries out financing activities. Those financing activities are represented under current liabilities. You know, bank loan, leases, debentures are non-current liabilities. Non-current liabilities. And you know, equity shares, retained earnings are equity components. Equity components. Now, if you see company's statement of financial position, you can see companies investing activities and financing activities. You know, the statement of financial position under assets, you have non-current assets and current assets. Those are companies' investing activities. So the balance part is equity, non-current liabilities, and current liabilities. Those are companies' financing activities. So your statement of financial position in UK terms, balance sheet. In our context, we use the term statement of financial position. You can see companies investing activities and financing activities. Right. So if you see logically, what you can see from statement of financial position, what you can see from statement of financial position is what investments company has and how these investments, how these investments finance. So this is what logically you can see from the statement of financial position. So if you look at the balance sheet or statement of financial position, you can see what investment company has. You see, under assets, non-current assets and current assets. So current assets, you know, it's working capital. So what investment company has is non-current assets and current assets. Then the second part is how these investments have been financed. How are these investments being financed? So that's what you see as equity, non-current liabilities, and current liabilities. You know, non-current assets are financed through equity. There are situations non-current assets are financed through both equity and debt. So long-term debts are non-current liability. You know, working capital is financed through current liabilities. We have learned that, you see, working capital is financed through current liabilities. There are situations you finance working capital from long-term sources. You have learned in financial management. You can remember the concept of permanent working capital. You have learned that in financial management. So this is what you logically see from financial statements. This is very important when you are doing the analysis. Right. You should have a logical view of company's financial statements. So if you see statement of financial position, you see companies investing and financing activities. Companies investing and financing activities. So these are investing activities. Then these are financing activities. So once you have financed your investment, you can do the operations. Once you have financed your investment, so you have resources. Once your resources are acquired, assets are acquired, you have now assets, then you can do the operations. You know, operating results are in the statement of income. Operating results are in the statement of comprehensive income. Statement of income. From the statement of income, you see sales, cost of sales, gross profit, administrative, distribution expenses. So likewise, you see the operating results, finance costs, profit before tax. So likewise, you see the operating results. So these are results of companies' operating activities. Results of companies' operating activities. Now you see, companies' key activities are investing, financing. So with investing and financing, company gets resources. Company gets resources. Company have resources. Then company can do the operations. Then results of operating activities, you can see from statement of income. Statement of income. Then cash flow effects. Cash flow effects of all the activities. Cash flow effects of all your investing, financing, and operating activities, you can see from statement of cash flows. You can see from statement of cash flows. Can you remember in the statement of cash flows, you have three categories of cash flows. What are those three categories? Cash flows from operating activities, then you have cash flows from investing activities, and third one, cash flows from financing activities. You see again, operating, investing, and financing. Now you see cash flow effects of these three activities you can find from statement of cash flows. All the cash inflows and outflows related to these three types of activities you can see from statement of cash flows. Now you see, when you see financial statements logically, these are the three activities you can identify. Investing, financing. Investing, financing activities are in the, you can see from statement of financial position. Then results of companies' operating activities are from statement of income or statement of comprehensive income. Then cash flow effects of these three types of activities are in the cash flow statement. So if you want to find out what are the cash inflows and outflows relating to companies' investing activities, you can find from the cash flow statement. If you need to find out what are the cash inflows and what cash inflows and outflows are relating to operating activities, you can see from statement of cash flows. Now you see logically, financial statements reflect three types of activities: investing, operating, and financing. Investing, financing, and operating. Therefore, in the accounting analysis, you know the objective of accounting analysis. You are going to make the financial statement suitable for the analysis. In the accounting analysis, you are going to make the financial statement suitable for the analysis. Now you see financial statements reflect three types of activities. Then to make the financial statement suitable for the analysis, you have to analyze these three types of activities. You have to analyze these three types of activities. So if you have analyzed these three types of activities, and if you can make sure that these three activities are fairly represented in the financial statement, then your financial statements are ready to start the financial analysis. Now you see in the accounting analysis, we are going to analyze these three types of activities that reflect from the financial statements. Then from the analysis of these three types of activities, we are trying to make sure these activities are fairly at appropriate values represented in the financial statements. So we are trying to make sure these three types of activities are fairly, the meaning is at appropriate values. These three types of activities are represented at appropriate values. So fairly represented in the financial statements. Right. So I guess you have got this point. So remember, as an analyst, you should logically see companies' financial statements. You don't see from double entry point of view. By looking at the financial statement, you should be able to identify companies' investing activities, financing activities, and companies' operating activities. So such a logical view is very important to be an analyst. Now, you know, the truth is our regular accounting jobs vacancies are declining. Bookkeepers, right? Earlier we have bookkeeper, we see job vacancies for bookkeepers. Now you know the bookkeeping process is computerized. So with that you don't have much vacancies for job vacancies for bookkeepers. In addition, earlier, about 10 years back, the assistant accountants, accounts assistants, their task is to support the company's accounting process. Now we have computerized accounting systems. Some companies are using ERP. Then such tasks are computerized. Then you see a less demand for such positions. Now, in many cases, you see accountant is part of company's strategic management, right? Early accountant's role is to maintain the accounts, timely produce financial statements, and give those financial statements for managerial decision making. But today, in present situation, accountant job is the key part of the accountant's job is decision making. Accountant or finance director is part of the company's strategic management. Now you see there's a significant shift of the role of accountant. You see there's a less demand for such traditional jobs. Now these analysis skills are very important to be a good decision maker, right? That's why this course is very important in the present context. So you should have a logical thinking. Otherwise, whether you have a first class, second upper, that would be meaningless. Such analytical thinking, logical thinking is very important if you want to have a good progress in your career. Right. That's why you need to put more effort in learning these. Right. You will be realized when you go to the industry. Right. Now you see, we should analyze these three activities. So today we'll study about analysis of companies' investing activities. Now you see, when you analyze investing activities, we are focusing on current assets and non-current assets. After that, we'll analyze companies in the financing activities. Thereafter, operating activity. Right. So I have uploaded today's study material. You see under accounting analysis, analyzing investing activities. Analyzing investing activities. Right. So we'll start with current assets. Every company, the main three current assets are stocks, trade receivables, and cash. So these are the main three current assets. So under analysis of current assets, we'll study about stocks, receivables, and cash. Now you should remember here our objective is to make sure companies' investing activities are fairly represented in the financial statement. So we'll analyze companies' cash and see whether cash balances are fairly represented in the financial statements. So with the analysis, we'll get more idea about the company's cash balance. Similarly, we'll analyze the company's trade receivables and see whether trade receivables are fairly represented in the financial statements. Similarly, we'll analyze companies' stocks to make sure stock balances are fair enough in the financial statements. Then you can make sure the recorded current assets are suitable to do the analysis. Recorded current assets balances are suitable values to do our analysis. Similarly, we'll analyze non-current assets. So I'm repeating now, your objective here is to make sure the investments in the financial statements are fairly represented. When they are fairly represented, then you have more confidence that you can use these balances in your analysis. Right. So that's what our objective. Right. Now with the analysis, you have two types of outcome. One is you have more confidence. You have a higher level of confidence. You have a higher level of confidence that the balances in the financial statements, amounts and balances in the financial statements are suitable for the analysis. The second one, you get more idea about companies' various activities. After the accounting analysis, you have more knowledge about companies' investing activities, companies' financing activities, and companies' operating activities. So you have a better knowledge about companies, these three types of activities. So that will definitely help to your step number 3. So what is step number 3? Financial analysis. Financial analysis. Right. So in this week, now in your assignment, so during this week, you have to analyze companies' investing activities. You can follow the procedure. So the procedure we study during this lecture. But there are situations, some procedures are not applicable because your annual report may not include enough information for that. So we'll see that later on. Right. So during this week, now you try to do the accounting analysis for your company. So last week you have got the financial statement values into Excel. Right. So last week I have asked you to take the financial statement, all 5-year financial statements to your Excel workbook. So this week onward, you are doing accounting analysis for your selected company. Right. So later on, I'll explain how you can apply these to your selected company. Right. So today's topic is under accounting analysis. So we analyze investing activity. Under that, we'll analyze first current assets. Current assets. Under current assets, we are going to analyze cash, trade receivables, and stocks. You know, these are the three popular current assets: cash, cash and equivalents, trade receivables, and stocks. Right. So we'll start with cash. We'll start with cash. So in accounting, you have studied cash and cash equivalents consist of cash and cash equivalents. Cash equivalent. You know, cash include cash in hand, cash at bank. That could be a current account balance, savings account balance. There could be a fixed deposits, fixed deposit account. So all are cash at bank. All are cash at bank. In addition, you see a cash equivalent. So here cash equivalents includes investments that mature within 3 months. Investments that mature within 3 months. The best example is treasury bills. Best example is 91-day treasury bills. So if you invest today for on 91-day treasury bills, your investment mature in 3 months. Your investment matures in 3 months. So treasury bills, particularly these 91-day treasury bills, are part of cash equivalents. Now here you have to be very careful. You have to be very careful because there are situations, some of your cash equivalents are not ready to pay your day-to-day expenses. There are situations. It's very important. Practically, there are situations. Some of your cash equivalents are not available to pay your current liabilities. Right. Now think about companies' day-to-day operations. Now think about trading company. Trading company. What are the day-to-day operations of trading company? Trading company buys stocks. Trading company buys stocks. Sometimes stocks are bought on credit. Then you have trade payables. You have trade payables. Then from suppliers, you buy stocks on credit. Then you sell stocks on credit. Then you have trade receivables. Trade receivables. You see, you buy stocks on credit, you have trade payable. If you sell stocks on credit, you have trade receivables. Then you receive cash lately. Now, until you receive cash, you don't have cash to pay your day-to-day expenses. Then what you do is, you try to delay some expenses. When you delay expenses, your expenses become accrued. There are situations you cannot delay expenses. Then you have to go for short-term financing, like bank overdraft. Bank overdraft, because your cash receipts are late. You are getting cash receipts lately because you have sold stocks on credit. Then lately you get cash from customers, from trade receivables. Using cash, you pay your suppliers, you pay your accrued expenses, those delayed expenses, you settle bank overdraft. So if you have excess money, you don't keep in the bank current account. You invest in short-term securities like treasury bills. So we call it cash equivalent. Cash equivalent. For example, 3-month treasury bills, cash equivalent. Now you see, if you have excess money, you go for short-term investments. Sometimes you invest in securities that mature less than 1 year. Then cash equivalent. Example, treasury bills. Treasury bills that mature within 3 months. So your excess cash, you invest in treasury bills. So this is how your day-to-day operations work. So this continues as a cycle. There are situations, these cash equivalents are not available to pay your day-to-day expenses. Now you invest in treasury bills. If you need money, you can withdraw the investment and get money. You can withdraw the investment and get the money back. There are situations you can't do that. For example, sometimes you have pledged this treasury bill as a security for your short-term loans. You may have used these treasury bills investment as a security for your borrowings. Then you can't realize this investment because this is a security you have kept when you obtain borrowings, when you borrow money. Then this cash equivalent you cannot realize. You cannot convert to cash to pay your day-to-day expenses. So you should identify such situations in your company. So in the cash analysis, what you do is you find out what are the items of cash company has. Is there any cash equivalent? If there's a cash equivalent, you see whether such investments have been kept as securities for your borrowings. So in the analysis of cash and cash equivalents, you try to detect such situations because that's very important when you calculate your liquidity ratios. Now, for example, now let's say these are restricted. Your cash equivalent you cannot use for your, or you cannot realize to pay your day-to-day expenses. Now, for example, let's say these treasury bills investments you have kept as securities for borrowings. Then you cannot utilize whenever you need money, you cannot withdraw this investment because these are now kept as securities for your borrowings. Then how do you pay current liabilities? You sell stocks. How do you pay your current liabilities? You sell stocks, then receive cash from customers. Using such cash receipts, you can pay your current liabilities. Now, these are your current liabilities: trade payables, accrued expenses, and bank overdraft. You cannot withdraw these treasury bills investments to pay your current liability. Now, you see, in your day-to-day operations, you sell stocks, then receive cash from customers. Using these cash receipts, you can pay your current liabilities. These cash equivalents are not available to pay your current liabilities because they have been kept as securities for your borrowings. So in the cash analysis, so you have to analyze cash equivalents and see whether your cash equivalents, or see whether there is any cash equivalent you have kept as securities for your borrowing. Then if that is the case, you have to be very careful when you calculate liquidity ratios because these cash equivalents are not available to pay your current liabilities. So that's the learning point. That is the point you should remember when you analyze your cash equivalents. Right. Now let's see a simple example. Right. So remember, you don't expect these kind of questions, a question similar to what we do in the class in your exam. So with these small questions and tutorials, I'm trying to build up your logical thinking. Exam is different. Don't expect a question similar to what we did in the lectures during the lecture hours in your exam. Right. So here my objective is to build up your logical thinking. You can remember we did 2 tutorials. So every time I'm trying to build up your logical thinking. So that is the skill you should have developed at the end of this course. That is one of the skills highly valued in the industry. Right. That's one of key skills our industry highly value. Thinking logically by doing various financial analysis. Right. So I'm trying to build up your logical thinking. Then in the exam, you will apply your logical thinking to answer the exam paper. Right. Now you see, if you do not regularly practice, right, then there would be some problems in your exam. You cannot do this, study this subject at the last moment. Right. So you have to work now onwards. Then gradually your analytical skills are get developed. Right. You know, skill development is a gradual process. Knowledge you can acquire within a very short time period. Remembering, understanding, explaining something. So that's about knowledge. You can do within a very short time period. But you know, skill development is a gradual process. You cannot get it developed. You cannot get it developed all of a sudden. So gradually. So if you practice regularly and try to think logically, then your skill, analytical skill, is gradually get developed. Right. So that's what's expected in the course, in this course. In the exam, you will apply your analytical skill to answer the exam question. So you will get a different scenario, different case. Right. You cannot find one similar to the case you get in the exam in the tutorial. You cannot find a similar case in the tutorial. You will get a very completely different scenario. The only thing you have is analytical skill. So you have got developed to a certain extent throughout the semester. That skill you will apply in your exam. Right. So don't think since it's online exam, you will have a chance to copy. Right. So I can remember all those who copy last time got very low results. So don't expect I will copy from somebody and complete the exam. Right. So you cannot do that in this subject because you are answering every exam question in this subject with your analytical skills. Right. So that's why I'm asking you to practice continuously, involve in the tutorials, and do your assignment according to my guideline. Otherwise, you will lose the opportunity to get your analytical skills developed. So that's only one-time opportunity. You will not get this kind of opportunity even with the professional exams. Professional exams within a very short time period, you have the exam. Every 6 months you have the exam, right? So even with that professional exam, you have very less opportunity to get your analytical skills developed. But with the practical training, you can develop to a certain extent. From the exam itself, you cannot get your analytical skills developed. So this is only one-time opportunity. You see, while we are learning the lessons, we apply into a real company. So with your assignment, our learning, we are going to apply into a real company. So this is only one-time opportunity. So I know even last years, those who have worked very hard during this semester have gained a lot. They were got appreciated during the industrial training. So I have a lot of examples. And they were got promoted soon after the industrial training. Now they have got permanent in their position. Right. So I know good examples of such dedicated students over last years. Right. Therefore, this is only one-time opportunity. While learning, you are going to apply your learning to a real company. Not to a Sri Lankan company, a UK company. So when you really do the assignment, according to my guideline, you will get exposed to a foreign company. Because you have seen many times financial statements of Sri Lankan companies. You have seen many times financial statements of Sri Lankan company. But getting exposed to a real company, according to my knowledge, you have not experienced. Getting exposed to a foreign company, you have not experienced. Right. Therefore, every time I'm asking you to follow my guidelines and do your assignment accordingly. Right. Then you will realize your skills before starting this semester has got developed by the end of the semester. You will realize by yourself the difference between you are at the beginning of the semester and at the end of the semester. So follow my guidelines. You will be benefited. Right. Right. Now you have the point here. When you analyze cash and cash equivalents, that's under current assets. You have to be very careful about the cash equivalents. Right. Now let's see the example. Let's see the example. You have a current assets as at 31st March 2021. So one of the current assets is cash equivalent. Then current liability is 550. Now you see 50 million value of treasury bills You see, 50 million value of treasury bills which mature within 3 months were pledged as security for loans. Now you see these treasury bills mature within 3 months. Therefore, this goes to cash equivalent. Now you see these treasury bills are matured within the next 3 months. Therefore, that goes to cash equivalent. Now you see cash equivalent consists 50 million. These 50 million treasury bills company has kept as security for loans. Now you see these have been kept as securities for loans. The meaning is whenever you need money, you can withdraw the investment. You cannot withdraw the investment. Whenever you need money to pay for, let's say, trade payables, you cannot withdraw the investment and get the cash back. You cannot withdraw the investment and get the cash back. Because it has been kept as security for loans. Now question is, calculate current and quick ratios. Calculate current and quick ratios. So let's calculate now. Current ratio. Current ratio equal, current assets divided by current liabilities. Now let's say you got a ratio 2. So what does it mean? Let's say you got current ratio 2. So how do you explain current ratio 2? How do you explain current ratio 2? For 1 rupee of current liability, you have 2 rupees of current assets. You have 2 rupees of current assets to pay 1 rupee of current liability. Now you see, you take current assets, only those current assets that are available to pay current liability. Now this is how you logically understand the meaning of the ratio and apply the relevant value. Now that's very important. So every time, don't remember the formula. So you logically understand the meaning of the ratio and apply the values accordingly to calculate the ratio. Now here, so what is the meaning of current ratio? Now if you have current ratio of 2, what is the meaning? You have 2 rupees of current assets to pay 1 rupee of current liability. ₹2 of current assets are available to pay current liability. 1 rupee of current liability. Now you see, when you calculate the current ratio, you have to take those current assets. You have to take only those current assets available to pay current liabilities. You take only those current assets available to pay current liabilities. Now, in this example, we have total current assets 1250. But entire 1250 current assets are not available to pay current liabilities. Because question says cash equivalents include 50 million. These 50 million treasury bills company has kept for borrowings. Therefore, you cannot withdraw this 50 million treasury bill to pay your current liabilities. You cannot withdraw these 50 million treasury bills to pay your current liabilities. Now you see from total cash and cash equivalents, 50 million is not available. 50 million is not available to pay current liabilities. Only the balance 50 million is available to pay current liabilities. Only the balance 50 million is available to pay current liabilities. Then how much current assets available to pay current liabilities? Cash and cash equivalents 50, trade debtors 500, inventory 650. So how much total current assets available to pay current liabilities? 50 plus 500 plus 650, 1200. You see current assets available to pay current liabilities only 1200 divided by current liabilities 550. So you get the current ratio. You get the current ratio. I guess you have got the point. That's why I'm telling you logical thinking is very important. Otherwise, you can't be a good analyst. Then how about quick ratio? Quick ratio. Quick ratio. You know, for the quick ratio, you don't take inventory. For quick ratio, you don't take inventory. So why don't you take inventory? Because usually we find realization of inventory. It takes time, but that depends on business. Let's say you are running a trading business. Your inventories are very moving fast. Your inventories are moving very fast. Think about supermarket. Some inventories are moving very fast. Then you can take such inventory to calculate quick ratio. Like soap. Think about supermarket. Soap is moving very fast. Vegetable moving very fast. Right. So essential consumable products are moving very fast. But items that are not that essential, for example, various high price creams, right? They are not moving very fast. Now you see, in a supermarket, realization is slower for some products. Some products are quickly realizable. So practically, you don't eliminate the entire inventory when you calculate the quick ratio. You can remember, quick ratio equal from the current assets. You know the theoretical formula. From the current assets, you deduct inventory divided by current liabilities. Divided by current liabilities. Now you have to see logically why you have eliminated inventory when you calculate the quick ratio. Because normally we assume the realization of inventory is lower than other current assets. So it takes time to sell inventory and convert it into cash. But for certain businesses, inventories are moving very fast. Some inventories are highly realizable. They are highly liquid. So the best example is supermarket. Think about Cargill's or Kiehl's. Essential commodities like vegetables, food items, essential items are moving fast. They are highly liquid. But certain items like car care items, vehicle, let's say a vehicle, the washing liquid, and some high price creams, hair gel. So those cosmetic products are selling slower than those daily essential commodities. Now you see, in a supermarket, some inventories are highly liquid and some inventories liquidity is lesser. So when you calculate quick ratio for a supermarket, you don't eliminate the entire because there are inventory items which are highly liquid. There are inventory items which are highly liquid. So you eliminate only lower liquidity inventory items. Inventory items that are not moving fast. Such slow moving inventory items are lesser liquid, liquidity is less, then you can eliminate only those. Now that's why I'm telling you, you should logically see a ratio before the calculation. Right. Now we'll assume for our example, the entire inventory liquidity is lower. Then for the quick ratio calculation, you take only cash and cash equivalents and trade debtors. But you can take only cash and cash equivalent 50 because that 50 is not available for you to pay current liabilities. Then quick ratio, this 50 plus 500, 550 divided by current liability, 550, quick ratio is 1. Quick ratio is 1. So this is about cash and cash equivalents. Then let's see inventory. Now we are analyzing current assets. Right. So I'll give before that another example. Now let's say a company's current assets include inventory, let's say in rupees million, thousand, trade receivables, 500, prepaid expenses, 300, and cash. There's no cash equivalent, only cash, 200. Total current assets, 2000. Let's say current liabilities, 1000. Current liabilities, 1000. So my question is, how much current ratio? How much current ratio of this company? How much is the current ratio of this company? Well, current ratio equal current assets divided by current liabilities. So every time remember, you take only those current assets that are available to pay current liability. Take only those current assets that are available to pay your current liabilities. Now, if you see the current assets, inventory is available to pay current liabilities because you sell inventory. Once you receive cash, you can pay current liabilities. Trade receivables is available to pay current liabilities because once you receive cash from customers, once you receive cash from those credit customers, you can pay current liability. Cash is available to pay current liability, but prepaid expenses are not. Prepaid expenses are not. Now, what are the current assets available to pay current liabilities? 1000, 500, and 200. You see, 1000, 500, and 200. The total current assets available to pay current liabilities, 1700. Current liabilities, 1000. Current ratio, 1.7 times. Now you see, you logically think and calculate the ratio. So this is what analysis requires. Otherwise, your analysis is meaningless. So you should every time think logically when you do the analysis. Now you see, even when you calculate a ratio, that logical thinking is very important. So if you just take 2000 as current assets to calculate current ratio, you are getting a wrong answer. You have overestimated the ratio. Then your analysis will become meaningless. Right. Now let's analyze inventory. So you know inventory cost allocation method, right? You have studied those. According to LKS 5, sorry, LKS 2, in our context, we can apply FIFO or WSC. So in Sri Lankan context, for inventory cost allocation, to calculate the inventory costs in the financial statement, you calculate inventory costs, compare with NRV, and get the lower value. According to LKS2, inventory costs you can calculate on FIFO or WSC. But in a UK context, you can apply LIFO method also. So in Sri Lankan context, LIFO is not allowed. But in a UK context, this LIFO method is allowed. Right. Now using this cost allocation method, you have studied in your A levels, maybe in your second year under cost management accounting. You have studied this cost allocation method. Now you are going to see logically. You are going to see logically what happens in this method. Right. So here what happens is, with these cost allocation methods, you are going to allocate inventory costs between cost of sales and closing stock. So all these, with this cost allocation method, you allocate inventory costs, cost of the company's inventory between cost of sales and closing stock. Now let's see simple example to understand this point. Now let's see this simple example. So on 1st January, you had 40 units. At the beginning of the year, you had 40 units. These 40 units have purchased at the price of 500. Now you see your beginning stock value, 20,000. Beginning stock value, 20,000. During the year, you have purchased 60 units. You see, 60 units at the price of 600. In an inflationary situation, now you see the real real situation in our country. The product prices are going up because we face very high inflationary situation. The product prices are getting up within a very short time period. This is a very high inflationary situation in our country. Not only our country, in many countries in the world. Now you see such inflationary situation given in this example. You see a beginning stock at 500, the price is 500. Price of the beginning stock is 500. The meaning is last year you have purchased stocks at 500. Last year you purchased stocks at 500. But during the year you purchased stocks at 600. You see price has increased. So your purchases are 36,000. Now you see during the year you have 100 units for sale. You have 100 units for sale. The cost of the goods available for sales 56,000. 56,000. Sorry. So by using FIFO, LIFO, WAC method, what you do is you allocate this cost of inventory available for sale between cost of sales and closing stock. Now you see during the year you have 100 units. You have 100 units for sale. At the beginning you had 40. During the year you purchase another 60. Altogether you have 100 units for sale. The cost of these 100 units 56,000. So the stocks available for sales 56,000. So using the inventory cost allocation method, what happens is these stocks available for sale stocks available for sale 100 units, cost is 56,000. Cost is 56,000. So this 56,000 costs you allocate between cost of sales and closing stock. Cost of sales and closing stock. Now let's say you are following FIFO method. Now let's say in this situation you are following FIFO method. How much closing stock value? You see the question again. You see the question again. You see during the year, you have sold 30 units. You see during the year, company has sold 30 units. Selling price 800. So how much closing stock value under FIFO basis? How much closing stock value under FIFO basis? Quickly find out closing stock value. Now we are applying FIFO basis. How many units of closing stock? You had 100 units. You have 100 units. Out of 100 units, 30 sold. Then closing stock, 70 units. Closing stock, 70 units. So how much its value? How much its cost under FIFO basis? How much its cost under FIFO basis? You know, under FIFO basis, the recent prices goes to closing stock. Under FIFO basis, stocks are price valued at recent prices. So stocks are valued at current prices, recent prices. Now you can remember, beginning the price is 500. You see how this 56,000 is made up. Beginning you had 40 units at 500. During the year you have purchased 60 units at the price of 600. Then altogether 56,000. You see, recent price is 600. You see, recent price is 600. Recent price. So you purchase 60 units at 600. Then closing stock value out of 70. Out of 70, you can value 60 units at 600. 36,000. Out of 70, you can value 60 units at the price of 600. Then 36,000. Then the balance 10 units, because the closing stock 70 units. The balance 10 units you can value at the previous price. Previous price is 500. The previous price is 500. 5,000. Then closing stock value 41,000. Closing stock value 41,000. 41,000. Then out of 56,000, closing stock value 41,000. Then how much cost of sales? If recent price goes to closing stock, then cost of sales are valued at All prices. Now you see you have sold 30 units. You have sold 30 units. You see a recent price or current cost has gone to closing stock. Then cost of sales valued at all cost. How much all cost? 500. All price is 500. Then 30 units at 500. Then cost of sales 15,000. 15,000 plus 41,000. You get cost of goods available for sale 56,000. 56,000. Right. Now you see, in FIFO basis, recent cost has gone to closing stock. Then cost of sales is valued at all cost. Cost of sales valued at all cost. So if the company applies FIFO basis, you see stock values are at current prices, but cost of sales at all prices. Right. So this is about FIFO. Let's see LIFO basis. So we have cost of stocks available for sale 56,000. Cost of stocks available for sale 56,000. So this is how this 56,000 is made up. Beginning you had 40 units at the price of 500. During the year you have purchased 60 units at the price of 600. Now question says, out of these 100 units, can you hear me now? Can you hear me?
Yes, sir.
Right. So I don't have power supply now. Right. So we'll try to continue.
Yes, sir.
So you have sold 30 units. Then cost of sales include those units sold. 30 units. Then cost of 70 units goes to closing stock. Cost of 70 units goes to closing stock. Now apply LIFO method and find out how much cost of sales and how much closing stock. Quickly find out. In LIFO method, in LIFO method, recent prices, current prices goes to cost of sales. All prices goes to closing stock. In LIFO method, cost of sales valued at current cost. The current price is 600. Then these 30 units valued at 600. These 30 units valued at 600. Then cost of sales 18,000. Cost of sales 18,000. Then closing stock includes all cost. The all cost goes to closing stock. Now you see out of 70 units, 40 units you value at all costs 500, 20,000, balance 30 valued at the next price 600. 600. 18,000. Then closing stock 38,000. You see a closing stock 38,000. You see 38,000 plus closing stock plus cost of sales equal cost of the goods available for sale. Closing stock plus cost of sales equal cost of the goods available for sale. In FIFO also the same. In FIFO method, closing stock 41,000, cost of sales 15,000, the total equal cost of the goods available for sale. Now this is what happens in FIFO, LIFO, or weighted average cost method. So this is your learning point. So in these costing methods, what happens is companies stocks available for sale, cost of the stocks available for sale, you allocate between cost of sales and closing stock. So in FIFO method, you know, current cost goes to closing stock. Therefore, all costs remains with the cost of sales. But in LIFO method, current cost goes to cost of sales. Then the all costs remains with closing stock. All cost remains with closing stock. Right. Now let's see a weighted average cost method. Let's see a weighted average cost method. So you have 56,000 cost of stock, 56,000 cost of stock available for sale. So this is made up with two prices, 40 units at 500, then 60 units at 600. Now you have to allocate between cost of sales. The company has sold 30 units. And closing stock. Closing stock 70 units. Closing stock 70 units. So you know in weighted average cost method, you get the weighted average price. So you have to get the weighted average price. Weighted average price. So how do you get the weighted average price? So you have 40 units at 500, 60 units at 600. The total cost 56,000. This is from 100 units. Then weighted average price 56,000 divided by 100 units. Weighted average price 560. 560. Then your cost of sales and closing stocks are valued at weighted average price. Cost of sales 30 units. 30 multiplied by weighted average price. Closing stock 70 units. 70 multiplied by this weighted average price. Weighted average price. Now you see in the weighted average cost method, the cost of sales and closing stock include average of old and current prices. Average of both old and current prices. You see, old price is 500. Last year price is 500. Current price is 600. This year price is 600. You see, you got average of last year price and current year price. weighted average of last year price and current year price. So in the weighted average cost method, you find both you find in both closing stock and cost of sales average of last year old price and current price. Right. Now this is how these three costing methods are applied to find out cost of sales and closing stock. Now, if your company follows FIFO method, you see a closing stock value is at current cost. So if your company follows FIFO method, you see closing stock value at current cost. But cost of sales value at old cost. You see the study material. So if your company follows FIFO method, closing stock at current cost, but cost of goods sold at old cost. It is not at current cost. But if your company follows LIFO method, cost of goods sold at current cost, but closing stock is not at current cost. Closing stock is not at current cost. So we'll see how these costing methods impact on financial statements. So we'll see which costing method is suitable for our analysis. If your company follows FIFO method, you see inventory at the current cost, but cost of sales at old cost. We'll see how that impact on your profit values. But if your company follows LIFO method, you see inventory at old cost, but cost of sales at the current cost. So we'll see how this impact on your analysis. Then depending on that, we'll have to see whether some financial statement values has to be adjusted before starting the analysis. Right. So we'll have to do this kind of analysis. So we'll study that in our next class, next lecture. Right. So before coming to next class, so you should work on this example, and find out answer for question A. So before the next lecture, you work out the answer for question A. Question A. Right. So question A is about calculate cost of goods sold and closing stock, gross profit value under alternative cost allocation methods. Here alternative methods are FIFO, LIFO, and weighted average cost. FIFO, LIFO, and weighted average cost. Right. So next time you come with this answer. So we'll see how these methods affect our analysis. How these methods impact on our analysis. So based on that understanding, you see some financial statement item values has to be adjusted. They have to be adjusted. So we'll study that point next time. Right. So next time we are going to complete analysis of current assets. If we have time, we'll move on to the non-current assets. Any questions you have? Any questions? So remember, now we are in the accounting analysis. So you should know the purpose of accounting analysis. So you should know why we do accounting analysis. Right. If you have any question, you can ask. Right. Then see you next time.
Thank you, sir.
Thank
Yeah,
you,
but-
sir.